Hi, I'm Mark Mayoka, founder of the Core 7 Referral System and best-selling author of What's Your Rate? I help real estate and financial professionals form structured mastermind groups to generate more referrals and add value to their clients. Today, we're going to walk through the What's Your Rate package seminar workbook, and I'm going to discuss why it's critical to review. This workbook follows my Amazon best-selling book, What's Your Rate, in order step by step. You can also reference the pages with the reference guide that speaks to each point. Now, the first thing you should do is try to get everyone to set some goals by asking the question, if we were meeting 3 years from today and you were to look back over those 3 years to today, what has to have happened financially during that period for you to feel happy about your progress? When something gets written down, it has a better chance of getting done. Next, have your seminar attendees write down their fears and concerns. What fears, concerns, or dangers do you feel you are facing at the present time? Give them a few examples as a guide. Confronting financial fears is many times the first step to improving. Thirdly, ask the question, what strengths and opportunities do you feel that you have financially? Give examples of what may be possible. Everyone has strengths that they can focus on that will give them hope for the future. On page 2, I discuss why I wrote the book, What's Your Rate? I talk about my personal story that is discussed on page 9 of the book. I do this to illustrate the importance of having a full financial team and a plan. The key point is to show how a small hole in someone's financial plan can really be catastrophic, and it should never be ignored. Even people who seem to have their entire financial world under control can have some risk. Next, review some immediate financial needs that the purchase of a home can trigger. Number 1, estate planning. Once someone owns a home, they have an estate and need to protect it with a simple will, a healthcare proxy, and a durable power of attorney at least. Number 2, mortgage payoff if you pass away. Having life insurance that will pay off the mortgage debt so that the burden would not be left on your loved ones. This is a key financial need. Most people don't consider that if they passed away early, the debt would still be there. It's critical to address this when a home is purchased. Number 3, making mortgage payments if you were unable to work. If a client was injured or unable to work, how would the mortgage get paid? Address the benefits of speaking with a financial advisor to discuss disability insurance. Disability is the largest cause of foreclosure. Number 4, replacement of income if you were to pass away. This is another life insurance need, and in my opinion, the most important consideration. Consider life insurance to replace the income needed to pay the mortgage and to release the loved ones of the burden of having to pay the mortgage, or in worst case scenario, go through the foreclosure process while they're mourning the loss of a loved one. Very important to get this in place once you buy a home. Number 5, protection from lawsuits. Discuss the benefits of speaking with a property and casualty insurance agent about an umbrella policy to protect your client against being sued. Lawsuits are more common than a home being caught in a fire. Would you ever not purchase fire insurance? Number 6, management of your mortgage structure and real estate equity. Discuss the benefits of having a mortgage lender that manages your mortgage and looks for refinancing opportunities and other ways to save money. A reliable real estate agent will evaluate the property value on a consistent basis. Real estate values can fluctuate as much as stock prices, and the value of real estate can trigger many financial and mortgage opportunities. Number 7, tax benefits and tax strategies. You can write off the mortgage interest and real estate taxes on a mortgage and should consider tax planning. Your client is concerned with their monthly payment. A solid tax plan can help them. Simply adjusting their withholdings with their employer will create more cash flow. A great reason to bring an expert in to help them. Number 8, children, schools, and college. This is an assumption and not always a consideration for everyone, but in my experience, the purchase of a home can typically be the start of someone building a family. The problem is people tend to think in the moment and don't look far enough into the future. A client could be using all their money for the down payment of a home when it could make much more sense to consider a college savings plan, for example. Next, address the 2 common mistakes that I see people make regarding their finances: reactive decisions and fuzzy focus. People really need to think things through when making financial decisions. People tend to be very reactive and address only their immediate needs. Possibilities that need to be considered are the purchase of a home, children and schools, short-term emergencies, tax planning, retirement planning, estate planning, college planning, protecting your assets, and planning for your parents. At this point in the presentation, I introduce my book, What's Your Rate? How to Buy a Home and Secure Your Financial Future at the same time. Explain that it's a story about a family who buys a home and also gets their whole financial house together by assembling a Core 7 team. At this point, I hand out a copy of my book and explain that the rest of the presentation follows the book in detail. Explain who the Core 7 professionals are. I reference the book as it includes all 7 professionals in the Core 7 on the cover, and explain that it will show how these 7 professionals work together throughout the home buying process. The first professional is the real estate agent. The most important step when working with the real estate agent is to have a buyer's meeting. Emphasize the critical aspects that are addressed in the meeting: family goals and dreams, schools, if children are a consideration. How long will your client live in the property? Will it be a long-term purchase or a short-term purchase? Explain how this can affect their exit strategy. Stress the importance of the real estate goals being in line with their family and financial goals. After all this, it's now time to schedule a date to go house shopping. Next, make sure you speak with the second professional in the process, the mortgage originator. Explain that the most important step is to have a loan consultation, not a quick over-the-phone conversation, but a real consultation where all documents are provided. Explain the advantages of having a pre-approval at this point in the process. Next, go over the documentation needed and review the documentation checklist. At this point, go over the criteria for qualifying for a loan and introduce the 3 C's. Number 1, credit. Explain what goes into a credit score and also direct them to the What's Your Rate reference guide in the information packet that shows a pie chart on credit scoring. At this point, suggest having a loan consultation with a mortgage originator to analyze their credit. Sometimes there are mistakes that need to be addressed and strategies that can be done before purchasing a home. The next C is collateral. Express that this is the actual value of the property. Explain that property values are calculated by an appraisal, which is different from an inspection. Many times it's good to explain the difference between the two. The type of property is also a factor. Explain the different types of properties and how the risk factors of each can change how an underwriter looks at the loan. Explain there are different underwriting standards for 2 to 4 units, commercial properties, condos, and single families. Be sure to discuss non-warrantable condos and the stipulations that come with purchasing those type of properties. Now for the third C, capacity, a client's ability to pay. Explain debt-to-income ratios and mention the What's Your Rate reference guide that will show them where to get more detail on the ratios in the book. Explain that a client's savings history, down payment, and cash reserves also ties into capacity when an underwriter reviews a loan file. You can discuss different loan programs that down payments and cash reserves can have an effect on. This depends on your audience. You could explain FHA loans and other first-time homebuyer programs, jumbo mortgages, blended mortgages, and other strategies your audience may be interested in. Encourage your audience to start the pre-approval process at this point, as there are many details that can't be analyzed right there at the seminar. Explain that the information is analyzed by the mortgage originator and then submitted to the underwriter for approval. If the loan qualifies, a pre-approval is issued and typically is good for 90 to 120 days, which is typically how long the credit report is valid for. Now it's time to find the property. However, the process that's illustrated in the book, What's Your Rate, there is a step that I feel is very important at this point before looking at the property. Meeting with a financial advisor to do a no-obligation cash flow analysis. My reasoning is that all mortgage lenders use debt-to-income ratios based on principal, interest, taxes, insurance, mortgage insurance, and homeowners association dues, also known as condo fees, to figure out the housing payment. I speak of this with the acronym PITA Mia HOA. They also use debt that is on the credit report and financial documentation that the client provides. At this point in the process, I sometimes review some of the details of ratios that car installment loans less than 10 months may not be included. Child support that's listed on the pay stub would definitely be included. It all depends on how much detail you want to cover in your seminar. But the point of the cash flow analysis is so that a financial advisor can help them factor in lifestyle expenses like daycare, health club dues, entertainment, travel, and shopping, expenses that a mortgage originator doesn't look at. The financial advisor can also help the client understand how real estate will fit into their overall financial plan and other goals. For example, starting a business, long-term investments like retirement, college savings, charitable giving, and even creating a legacy. In my experience, clients who meet with the financial advisor feel much more comfortable with the home purchase. It's a little more time invested, but such a critical step, and it makes things so much easier. Now they're ready for the home search. At this point in the presentation, fast forward to when they find a property and are ready to make an offer to purchase. Explain that there are typically 4 possible responses from the seller. Response number 1, the seller will accept the offer on the first try. Explain this typically only happens in special circumstances, like a full price cash offer, for example. Seller response number 2, they will reject the offer with no response. This lets the client know that they are completely out of the ballpark and the offer will not even be considered. Seller response number 3, a token counter. Explain this means your offer may still be far off, but the seller is willing to engage and negotiate, typically dropping down a couple $1,000s from their original price. Seller response number 4 is a good counter. Explain that a good counter is close to the offered price. Strategy with your real estate agent is really critical at this point. Everyone needs to be on the exact same page. Then explain what happens after the seller's response. The first step is to professionally negotiate. There's never a reason to get confrontational because it's just business. Negotiate professionally, and the seller will take your offer more seriously. Then segue to the offer being accepted. Recommend bringing in the real estate attorney to review the offer before signing purchase and sale at this point. Have legal representation as soon as possible. The next step is the signing of the purchase and sale. Explain that there are 2 important dates on the purchase and sale. Mention that their attorney, real estate agent, and mortgage originator will help monitor these contingency dates. These dates are the inspection contingency and mortgage contingency. At this point, explain what those contingencies mean in detail. Bringing this up triggers questions regarding both dates, especially the mortgage contingency. Make sure to be crystal clear when describing their impact. The next step is the reconsultation with the mortgage originator. Explain that there are 4 points that are reviewed at reconsultation. Number 1, the loan program and structure. Explain that there are so many ways to structure a mortgage, and sometimes the lowest rate with the wrong structure can be far more expensive than a competitive rate with the right plan. Number 2 is to review the mortgage-backed securities market and what makes interest rates fluctuate and whether to lock or float your interest rate. Explain that good news about the economy is bad news for mortgage rates, and bad news about the economy is good news for mortgage rates. As a side note, always mention the What's Your Rate reference guide that will refer to these pages in the book that cover mortgage rates and fluctuation in detail. Point number 3, review the closing costs. Now, I like to show my clients a higher level view of the closing costs as they're going to be similar with any lender the client chooses. Explain that there are 3 buckets of what people consider closing costs. These 3 buckets are lender required closing costs, your escrow account, which include real estate taxes, homeowners insurance, prepaid interest, and mortgage insurance if required. And the third bucket, optional closing costs, which include owner's title and your buyer representation fee. Review the advantages and explain that there are some great articles that go over the details in the What's Your Rate information booklet that's included in our What's Your Rate package. The fourth thing to review at the reconsultation is to describe the total cost analysis that will be prepared after the call or meeting. This will give a side-by-side comparison in writing that will illustrate each program that was discussed. Moving forward, explain that the next step is to speak with the property and casualty insurance agent and that the lender will typically make this introduction. Always mention to discuss the benefits of an umbrella policy for protection in case you are sued. I always reference that only 1 in every 12,000 home catches on fire in a person's lifetime, and all lenders require home insurance. However, 1 out of every 200 people are sued, but this type of insurance is not required by lenders. Make sure that they review their options, as the home will many times be their most valuable asset. Go on to explain the next steps and review documentation gathering. Stress that they will be constantly updating documents like bank statements, W-2s, with the goal of obtaining a loan commitment letter. Reiterate what a loan commitment letter is and its importance in the process. Then explain the HUD-1 settlement statement that will review the final numbers. Explain that when they first see these numbers, that the numbers may not be correct, but not to panic. This is very common. The closing attorney will review those numbers before the official closing. Next is the closing, which I like to call a celebration. They are now a homeowner, and this is a big deal. Now, this is a critical point in the seminar. Make sure everyone in the room pays attention. The biggest mistake people make is right at this point. They don't continue with the process. Explain that the Core 7 process is designed to show your audience how to buy a home and secure their financial future at the same time. Encourage your audience not to stop at the home closing. Continue through the process. Moving forward, review the next steps in the process. Number 1, reconnect with the financial advisor. Explain that they hopefully spoke with the financial advisor and did a cash flow analysis during the home buying process. Now it's time to take step number 2, which is to establish your financial goals. This ties into what the seminar attendees wrote down on page 1 of this packet when they were addressing their strengths, fears, and their goals. Take them back to page 1 to clarify this. This is where a financial advisor can really help them. Explain that this is where the financial advisor will ascertain the client's core values. Core values include security, peace of mind, financial freedom, legacy, and even just to have fun and relax. Step number 4, start a savings plan and build up your cash reserves. There are expenses that always come up when buying a new home. It's important to establish a savings plan to address future needs. I always explain my opinion when it comes to cash reserves. If a person is self-employed or depends on commission and bonus income, they should have at least 6 months cash reserves. If they are an employee who is salaried, I recommend at least 3 months of cash reserves. However, I always let my seminar attendees know that they should have an amount that helps them sleep peacefully at night. Next, recommend reviewing insurance policies for protection against untimely death, disability, and lawsuits. This is the foundation of a financial plan. Next, review retirement savings and retirement goals. A good rule of thumb from Charles Schwab is a typical person will need to save $135,000 for every $1,000 of desired monthly income in retirement. For example, if someone needs $10,000 in monthly income during retirement, they would need to save $1,350,000 to make that feasible over a 20-year time span. The next step you can address is college planning. Some college funds are listed below. My personal opinion is that people should fund their retirement first. There are many student loan options, and children could work their way through college. The reason I have this opinion is because I don't feel a person should put off funding their retirement to save for college. I always suggest consulting a financial advisor who's licensed to give you advice, but my theory is that children are probably going to get all of their parents' money when their parents pass away, so all the loans could be paid off at that point. That's just my personal opinion and a good talking point for the seminar. Next, a client should meet with the estate planning attorney. Now, clients should take the financial advisor's advice on how their estate plan is structured, but 3 steps should be taken right after the purchase of a home. Number 1, create a will to avoid costly legal fees and aggravation for your loved ones going through the probate process. Number 2, create a durable power of attorney if a client is unable to make decisions for themselves. And number 3, a healthcare proxy. The next professional is the accountant. There are 2 things to do right away. Number 1, increase the W-4 withholdings with your employer for proper cash flow and tax planning. Examples are having more in their paycheck. Another example is they could maximize their 401k contributions. The key is they need to consult an expert for the best personal strategy. The second step is to ensure the entire Core 7 team is collaborating and working together on your behalf. At this point, let everyone know they should put together a full financial team as soon as possible. Then address the 5 most important disciplines to keep their Core 7 professionals working together and to have the best overall financial plan. Number 1 is a quarterly or biannual financial review with your financial advisor. Explain that they should always review their net worth and the potential to increase dollar cost averaging contributions on a monthly basis. Number 2, a mortgage review every 1 to 2 years. Explain how many refinance opportunities there are. And at this point, I personally tell stories that I've illustrated in the book What's Your Rate on how I've managed my clients' mortgages and saved them thousands by staying in touch and having a mortgage review. We all have great stories like that to tell. Number 3, have an annual equity review with your real estate agent. Big increases in equity can have significant financial ramifications for people. For example, they could consolidate debt, refinance to lower interest rates, pull cash out, or shorten some of their loans. Number 4, have a face-to-face meeting with your accountant at tax time. Your accountant will know your situation better and be able to ask questions to create more tax savings. Accountants are preparing so many tax returns in such a short period of time, it is possible to miss something if you're not explaining any changes in your financial life. Number 5, review and update your estate plan every 3 to 5 years. An estate plan may need to be updated for many reasons. New additions to a family, changes in what someone desires to pass on, and many other situations that can create changes in someone's estate. Next, address the enemies of a sound financial plan. Number 1, a fractured network. Explain that a full team working and collaborating together on a customer's behalf is incredibly important. For example, a mortgage lender who is in charge of a client's debt strategy needs to be collaborating with the financial advisor who is responsible for the client's asset strategy. If they're not collaborating, one strategy may not match up with the other. The second enemy of a sound financial plan is procrastination. The sooner something is put in place, the better. Give a few examples. Number 1, when it comes to saving for retirement, investing early gives your investments more time to compound. When it comes to insurance, the insurance premiums are much cheaper when a person is younger and healthier. Purchasing a home is something not to procrastinate. Homeowners are 42% more wealthy than renters. For estate planning, peace of mind and having a voice when you're not able to communicate anymore is a great feeling. The sooner you can have that, the better. Communicate the importance of implementing these strategies as soon as possible. In closing the seminar, create an action plan to implement right away. Number 1, if less than 6 months away from purchasing a home, contact or get a referral to a realtor and schedule a buyer meeting. As a mortgage originator, I always suggested to ask me for a realtor introduction right after the seminar. This increases the chances they will work with my Core 7 team. Number 2, if they are more than 6 months away from purchasing a home, contact or get a referral to a financial advisor to review their finances and possibly create a savings plan that's tax efficient. Step number 3, call a mortgage originator and schedule a phone consultation and a credit review. Let them know the higher the score, the better the mortgage terms will be. There also may be something on their credit report that doesn't belong to them. For those who own a property, contact your realtor and schedule an equity review. Reiterate that equity increases can create opportunities. Number 2, contact a mortgage originator and review if a refinance is feasible and get added to their mortgage management program. Even if a refinance is not feasible, at least they'll be on the radar for a mortgage originator to call them when it's time to refinance. Point them to the What's Your Rate reference guide for the story of my client who saved over $500 a month because of our mortgage management program. Number 3, contact a financial advisor and do a net worth assessment. Staying on track regarding your net worth is a great start. Next, have them write down a date and make a commitment to get these strategies implemented. Lastly, I like to touch base on my recommended reading list. I believe these are great books for financial and personal excellence. I hope this will assist you in delivering your presentation and helping your clients put together a full financial team and help them reach their financial freedom point. Thank you, and I hope you enjoyed this.